Good afternoon, everyone, and thank you for joining us. Trusting you're all keeping safe and well. My name is Vito Dintrono, Yarra Capital Management's Chief Commercial Officer, and I'm very pleased to welcome you to today's webinar with Tim Toohey, Head of Macro and Strategy, and Dion Hershan, Yarra's Managing Director and Head of Australian Equities. Today's webinar is entitled, Is Australia Facing a Fiscal Cliff? And in a moment, Dion and Tim will explore the merits of that question. More broadly, today's webinar, and in fact our entire webinar series that we've been running for the past 12 weeks or so, form part of our commitment to keeping you informed and connected through the COVID-19 pandemic. Before I hand over to Tim, a few housekeeping items. Firstly, you'll be listening to the webinar using your computer speaker system by default. If you prefer to join over the phone, please select telephone in the audio pane and the information will be displayed. And secondly, all participants are in listen-only mode, but you'll have the opportunity to ask questions right throughout today's session just by typing the question into the question pane and submitting, and we'll look to get to as many questions as we can at the end of today's formal presentations. Structure for today's webinar: firstly, we'll hear from Tim for roughly 10 minutes or 15 or so, then Dion for 10 minutes, and then we'll finish up with 10 minutes on Q&A before wrapping up a little after 3:30. And with that, I'd like to hand over to Tim Toohey.
Thank you, Vito, and thanks everyone for joining us again. Let's get right to it. A fiscal cliff, how worried should we be about it? Well, I guess first of all on slide 4, just to get some perspective, what the slide shows in the blue bars is what direct fiscal stimulus is. So this is government handouts, government initiatives, versus what are loan guarantees from the various major economies around the globe. One way to think about it is the bigger the stimulus, the bigger the fiscal cliff, but that's probably not the most appropriate way. Obviously, there was a budgetary estimating error by Treasury in terms of the size of the job keeper program. That's illustrated on this chart by the green bar. So if we include that, or if we assume, for instance, that accounting error that got passed through in the budget gets redistributed beyond September, you would easily make the case that Australia has the largest direct fiscal stimulus on the planet. If we move to the next slide, there is something to be aware of in terms of definitional issues around this. Economists will probably talk in terms of not really there being a fiscal cliff, because the way that most economists would interpret fiscal stimulus is really the net change in the budget deficit. So all governments do is collect taxes and then spend it. So if you're not collecting as much tax, but you're spending even more, and the budget deficit is incrementally going up, not just for the current financial year, but for the next one as well, then they would interpret that as the fiscal impulse, which is the change on the right-hand side of slide 5, is remaining very positive. And from that perspective, most economists would sit there and run a quite a simplistic view, but that's not really a fiscal cliff that we should be concerned about. Financial markets obviously have a different objective in mind, because they're very, very focused on the individual programs and the time frame for when they conclude. And as we've talked about in prior webinars, slide 6 shows you the magnitude of some of these programs. These are the ones that pertain mainly to the household sector. We're not putting through some of the depreciation type initiatives and write-offs initiatives for the business sector, for instance. But that's where the vast majority of the stimulus resides. So what's the point? Well, the first point is that for investors who are very focused on the individual programs, it shows that you're moving from July, which was, I think from early March when we did one of these webinars, we're illustrating would be the peak stimulus month, and it still is the peak stimulus month, would start to dissipate beyond that. But in essence, as we move through to October, then very little stimulus would still be in the system. We did have the home builder initiative that came out subsequently, which is very important in terms of the scale of the home building sector, but not overly important relative to the size of the other programs that have been there. Voluntary super, the cash handouts, the job seeker package, and the job keeper package. Clearly moving from a $22 billion stimulus in July to something that is around about 1.8 billion in October is a very steep drop-off. But is that the best way to think about it as well? Well, the answer is not really, because on slide 7, any fiscal measure should really be measured against the negative that package is designed to offset. So we've always calibrated the net income aspect of the fiscal stimulus as being relative to that income shock, relative to the big fall in employment, relative to the fall in hours worked, relative to basically wage rates being reduced as well. So the red line really shows you the net effect in this chart of the labour income shock mapped against the large fiscal stimulus. So the first point on this chart is that if there isn't any extension of the JobKeeper and JobSeeker programs, then clearly we would still move into a negative net income environment as we move through October and as we move through the rest of the 2021 year. So that's obviously still, a net negative. That's something to be concerned of, but nowhere near as large as what just looking purely at the individual fiscal programs concluding would suggest. Core point being that the faster that the employment and hours worked recovery commences and continues, it does, less stimulus is actually required at that point. Let's now put into the analysis what it looks like with our expectations of what will happen on July 23rd, when the Treasurer and the Prime Minister will announce their revised fiscal stimulus extensions. So slide 8 is just our best guess. We do think it'll be a modified extension of JobKeeper and JobSeeker. It's likely, if you believe the press and what the Treasurer has been suggesting, that the criteria will be tightened. People will not be able to be compensated by more than what they would have received prior to COVID commencing. And it's likely to move to a rolling revenue basis rather than just meeting that individual threshold in order to get full access to the system. So that's represented by the dotted bars as we move forward, which the arrows are pointing to on slide 8. For Job Seeker, we're assuming that the large extension in terms of the New Start allowance is essentially halved, and that then finishes up in the 2021 financial year. If we're broadly right on those assumptions, you can see that the red line stays in positive territory all the way through until the back end of 21. So that would be, I would put it, yes, it's a fiscal slowdown from peak stimulus, but it's not a cliff. It's not actually a negative in net income terms. Again, mostly or partly because the labour market is healing underneath. The packages are doing the job of keeping people engaged in the workforce and businesses engaged in their own operation long enough for the labour market to heal. What else do we know? What else do we think we know? Slide 9 was a chart that we used very early on in this series of webinars, saying, well, there was this additional quiver in the government's arsenal. They could always pull forward these tax cuts. Now, again, just to remind ourselves, on slide 9, the tax cuts were delivered in 2 separate budgets, and they were scaled to really implement or uplift in the 22-23 year and the 24-25 year. So when the Treasurer is talking about bringing forward the tax cuts, we're not quite clear about whether we're talking about bringing forward both increments in the 22-23 year and only that year, or scaling the whole tax cut forward. So what we've assumed in our analysis is they'll bring forward the 22-23 tax cut, but nothing else. So what would that look like? How would that change the analysis? It could obviously be larger, it could be smaller. Well, slide 10 gives you the visual impression for what that stimulus would look like. So here, the yellow bars are being added onto the prior chart, and the net effect is again the red line. So not only does it remain positive, the net income aspect would actually start to tick up again through the course of 21. Now we're assuming that the earliest that they implement the tax cut is from 1 Jan 21. They may delay it to 1 July 21. We're not quite sure, but nevertheless, the net story is still broadly similar. There isn't a large fiscal cliff that you should be concerned about from a household income and therefore retail sales or broader consumption across the economy embedded in the analysis. How does it fit with our prior views? Well, I would stress that on slide 11, we've always used this graphic, and you're probably sick of seeing it, but to describe at least the mental map of how we've seen COVID impacting the various aspects of the economy and then moving through the recovery phase and before we reach the new normal. Where we're at the moment is essentially halfway up on the V, where the unemployment rate is starting to fall. Now, you probably didn't see that from today's data in terms of the official unemployment rate, but when you add back in furloughed employees, the unemployment rate's been falling very smartly, and we might talk about that a bit later. Of course, we have no idea when international travel will commence again, but we have several months, I would say between 6 to 8 months, of data still improving sequentially, albeit at a slower pace, as we move into the more mobilisation across most of the country. 80% of the country is out of lockdown. Of course, 20% of the country, i.e. Melbourne, has moved back into lockdown. But there were 2 points on this. One, Melbourne was a laggard, so it was never actually recovering very fast relative to the other cities in any case, and it has subsequently reverted back to the lows of April, if we believe the mobility data and restaurant booking data. And secondly, the stimulus was so large relative to all other countries that it's had some truly amazing impacts. Retail sales are actually above pre-COVID levels. If you look on slide 12, for instance, you can see that the share of retail going towards the large retailers, which had been trending for a large number of years anyway, has step changed. There is a dramatic transformation of power across the retail sector to the large retailers. And of course, a large share back towards online as well. If we start annualizing out the impacts, as you can see down the bottom, we're talking about tens of billions of dollars that are potentially moving back towards the larger retailers with better online presence. And one of the more perverse things, which I'll conclude on, is that on slide 13, if you shut down the international tourism sector, well, Australia is actually a net importer of tourism in the sense that we spend more money when we go offshore than what foreigners spend when they come here. So, of course, one of the more perverse things when there is no tourism is that there's around about $19 billion in annual terms that is locked back in the economy that doesn't leak out. Now, of course, there are jobs that are associated with international tourism domestically that won't recover. But in net terms, we're probably talking around about $8 to $9 billion still net better off of income that is sloshing around the economy that will be looking for a home. It might go into savings, it might go into renovations, it might go into new cars. Nevertheless, there are some perverse things through the crisis that actually have been locking in money into the economy against what is an enormous fiscal stimulus and still better health outcomes than anyone else in our peer group. So I will conclude with the story, with the byline that yes, fiscal stimulus is diminishing, but you shouldn't be viewing it as a large fiscal cliff that will see the economy start to move back down into a subpar type environment. With that, I'll hand over to Dion.
Thanks, Tim. And I'll follow up with the conversation with some observations around the Australian equities market and, importantly, the cliff and the implications for the consumer. I think it's worth saying that the concept of the cliff has been widely debated amongst Australian equity investors, and there's almost this binary view that things could radically change on October 1st. As Tim described, that's absolutely not our view. We think it's better to be described as either a fiscal taper or a fiscal fade. What we do know about COVID is the definition of temporary, and temporary support is being tested. And there are a number of sectors and individuals that are going to require support well into 2021. The bridge that the government has described is basically going to have to be longer and more costly than originally anticipated. There are 4 reasons why we expect the support to continue. Firstly, that there is a real underlying need. Many sectors, such as tertiary educational travel, simply can't rebound in the short term. And similar comments could be made about Melbourne, 20% of GDP nationally, which has also had a severe setback. Second point I'd raise is the government has the capacity, and Tim outlined this before. It's a strong fiscal position, JobKeeper 1 underspent versus expectations, and that absolutely leaves room. The third observation is that fiscal support at this point in the cycle probably has a good payback for the government. Maintaining the linkage between individuals and employers is pretty powerful, and it avoids the worst case scenario of having a severe long-term unemployment pool of people that are reliant on welfare. The final reason I think it's highly likely is other government initiatives simply can't generate the same returns or impact in the short term. As tempting as it is to focus on infrastructure or renewable energy, they simply don't create the short-term sugar hit that this economy absolutely needs here and now. What we've observed since the outbreak of COVID, really on the local scene in March, has been pretty remarkable. In many respects, it's not what you would have anticipated in the middle of the pandemic. Retail sales, and Tim alluded to this a moment ago, for the 3 months up until the end of May, we're yet to get complete June data, but I expect the trend will have continued, actually grew versus the prior period. In summary, that 3-month period of lockdown saw the consumer spend about 4% more than they did in the prior year, which is remarkable, at odds with almost every prediction that was out there, and not what you would have anticipated in the middle of the onset of quite a deep recession. What we basically observed is as lockdown and hibernation kicked in, it wasn't a surprise that food and liquor sales boomed, and that went beyond people storing toilet paper. What we saw was there was a broad-based improvement in food expenditure, and there's a significant substitution away from people spending in cafes and restaurants. Anything that was home-related also surged. In fact, in the month of May, home-related expenditure went up 28% year over year, with furniture and consumer electronics really at the forefront. It wasn't a surprise to see that cafes, restaurants, and also apparel sales were down severely because mobility restrictions kicked in. What we effectively saw was a massive amount of displacement and substitution, but the consumer, on balance, spent more year over year in that 3-month time period. As you would expect, online sales also spiked, moving from 7% of turnover to 11% of turnover, a circa 40% increase, accelerating a structural shift that was already underway and is unlikely to be reversed post-COVID. Even for the large ticket items, there was also some strength and resilience. Car sales picked up dramatically in June, and housing prices have very much defied the skeptics so far and remained pretty resilient. So overall, retail expenditure during the pandemic has been remarkably strong, but we would recognise that there are some headwinds on the horizon. It almost appears in the months since COVID was a local phenomena, the consumers kept spending based upon the cash flow they received, with no real regard as to where the cash was coming from, whether or not it was welfare, drawing down superannuation, or other means, versus the step down in employment income, which also occurred. As Tim indicated, the cash flow support from the government won't evaporate, but logic would suggest it gets harder and harder for consumer-related companies here. In the short, medium, and long term, the employment prospects are more difficult, as they would be for income growth. In summary, we have a more downbeat assessment of what it means for the consumer, because unemployment will be higher than it was pre-crisis, and the sugar hit from the stimulus programs will progressively fade. As you start to turn to what this means for the Australian equities market, the cliff, or the so-called impact on the ASX 200, is interesting, and it might not be as large as many people would actually anticipate. It's worth calling out about 1/3 of the market are in sectors which are relatively immune to the fiscal cliff and the issues in the economy today. I'm referring to the resources sector, telco, and consumer staples. And of large Australian companies, on balance, about 40% of their revenue comes from offshore. So they actually aren't contending with the Australian fiscal cliff. They're contending with whatever programs might be in place in other countries. As we put a spotlight on the 3 parts of the market that are potentially vulnerable from this cliff that we've been discussing and debating, we call out its discretionary retailers, which is 7% of the market, its shopping malls, which are about 3%, and its banks, which are about 19%. On discretionary retail, I think the impact of the pressure that will be coming is reasonably obvious. What we'd point out is there will always be winners and losers. As was discussed before, we expect large retailers to win significantly at the expense of small independents. We expect online and omni-channel retailers to win dramatically versus physical retailers. And previously, experiences or services companies were growing much faster than physical goods. But with the mobility restrictions in place, we would expect that physical goods grow faster than experiences for the foreseeable future. There's always going to be a category shift as well. By way of example, if you look at what's been happening with department stores versus pure plays, you can see that some independent companies such as JB Hi-Fi have prospered, whilst the fate of Myer has been vastly different. So we're slightly underweight consumer-related stocks, and our number one holding is in fact JB Hi-Fi, which we think is a best-of-breed retailer. They've got cost leadership, a very strong online position, and consumer electronics just continues to take share of wallet. Turning to one of the other sectors I described, shopping malls, which are about 3% of the market, we think they're basically a major point of vulnerability. Many of the structural headwinds that the sector faced pre-crisis have now become almost like a tornado, and they're going to conspire to put a lot of pressure on these businesses. It stands to reason that shopping mall vacancies will go up, both because of bankruptcies and also viable tenants handing back space. Those businesses are struggling to collect cash from tenants in this environment, in part due to the regulatory uncertainty in some of the legislation. There's an accelerated shift to online, and the prospects of shopping malls increasing rent at 3 to 5% in perpetuity, like they used to do, looks very, very unlikely. So when you put it all together, the shopping malls might well be trading below the theoretical value of their assets, but we believe there is a lag associated with asset values. These businesses could prove to be value traps as the gearing goes up, the income becomes under pressure, and the cycle plays out. Looking at the banks, which are the largest part of the market that's arguably affected by the cliff, it's a far more complicated discussion to have, and there are many assumptions we need to make in analysing it. From a distance, some of these numbers do look ominous, but as you start to analyse the banks and the nuances associated with these issues, we think it's far more manageable. In summary, there's no real precedent for what we're looking at around the bank's interest and principal deferral programs which were introduced, which in effect allow consumers to defer mortgage payments for up to 6 months with the tacit, support of the government and APRA. And at this point, about 11% of all mortgages, or about $180 billion, actually have payments suspended, which obviously is going to lead to higher delinquencies in the future when that program ends, and also higher defaults. And we expect the deterioration in those loans to coincide with the reduction in fiscal support we've spoken about earlier in this call. What we'd expect, though, is although delinquencies and defaults may well go up, we don't think the losses for the Australian banks on mortgages will actually be that significant, because we think there's more resilience in this asset class than many people anticipate. The resilience really stems from a number of factors. Most notably, for Australian mortgages, if the loan-to-valuation ratio is above 80%, they are required to have mortgage insurance. So the first 20% fall in the value of a property is largely borne by an insurance company, not a bank. And those so-called high LVR loans are about a quarter of the total loans in place. The other thing we'd point out is that property prices so far have been very resilient and are largely responding to the fact that interest rates and mortgage prices remain very, very low. So the fact that property prices are remaining quite robust or steady suggests that there simply isn't the deterioration in prices that would cause large losses for the banks. And that, coupled with very low mortgage rates, means serviceability for mortgages in Australia is actually quite good. We continue to believe the largest risk for the Australian banks that we're monitoring closely is the quality of their SME loans, which simply don't have the same asset backing as mortgages. But to focus a bit more on the mortgage market, post-JobKeeper, we expect delinquencies will go up and that will lead to more defaults. Traditionally, delinquencies and defaults have been less than 50 basis points of bank mortgages. Going back to the 1993 recession, they were 3 times that level at 1.5%. We are assuming that delinquencies and defaults will exceed the 1993 levels and could easily be 3 to 5% of total loans. So we think there's a large cohort of mortgages which effectively will become delinquent given the spike in unemployment that we've discussed so far. But the central question then becomes, of those loans that go into delinquency or default, what will the losses actually be? And by virtue of the fact that property prices have remained reasonably resilient and the average mortgage only has a loan-to-valuation ratio of 50%, and the mortgage insurance I described a moment ago is also in place, we think the losses on mortgages that are being forced into sale will be relatively modest at 1 to 2% of the value of those mortgages. So if you assume elevated delinquencies and defaults, losses well above prior levels, you can expect that represents a 5 to 10% hit to bank earnings. But we would note that the banks have already put provisions in place to address these types of issues, and we think they're probably well covered and appropriately provisioned at this point in time. So we don't expect a severe mortgage bad debt cycle, but it is going to be noisy, and we think the sector is well capitalised to ride the bumps that seem inevitable. I guess my final comments will be to refer to the other cliff that we want to point out at this juncture, which is the valuation cliff. COVID was a very unlikely catalyst for valuations in the ASX 200 to actually go up, not down. And that's been particularly apparent in high growth tech and high valuation segments of the market. In simple terms, the pandemic didn't burst the bubble like we probably would have expected. In some respects, it actually inflated it. And that could be because of low interest rates and the abundance of liquidity. But to share a few observations, the ASX 200 is now 15% above normal valuation levels, looking out 2 years on earnings to a post-COVID world. The top quartile of our market actually trades at 40 times forward earnings, which is almost without precedent. For technology companies, it's hard to really describe what's going on from a valuation perspective, but it looks and sounds a lot like 1999. So from our perspective, we're being very careful about the companies we invest in. We're very focused on valuation. We don't know if and when a correction could occur, but we want to make sure our portfolios are resilient and well positioned around solid companies with a promising outlook. So with that, I might pause and we'll hand it over to questions.
Thanks, Dion. Pleasingly, quite a few questions have come through, so thank you for all of those, and do keep them coming. Tim, we might direct the first one to you. And the question is, presumably your modelling has some assumptions in respect to a second wave, particularly given what we're seeing in Victoria and New South Wales. Two questions. Do you have a base and worst case? And what does that mean for fiscal support?
Well, thanks, Vito. I think first of all, Victoria is fortunate in a way that the peak stimulus has been delivered at the worst time in terms of the second wave of cases. And today was a particular case in point in terms of the new cases announced. The worst case scenario is, of course, that it spreads beyond Victoria. But when we look at the data state by state, region by region, at the moment there's no case really to be made that New South Wales should be considering, and let alone Queensland or elsewhere, should be considering lockdowns. In fact, if anything, their premiers seem to have a different attitude to the Victorian premier, and that they have very little appetite to move into that phase in any case. The goalposts did shift a little bit. We were positioned in terms of buying time, if you like, to build capacity in the hospital system to deal with any subsequent outbreak. But Victoria has clearly pivoted to the idea that they will continue to shut down until they see an improvement. The fiscal component beyond, if it did move to a worst case scenario, as Dion said, there is still plenty of capacity. The government can continue to do what it's doing. Bond yields are incredibly low, so they can continue to finance, if you like, the stimulus as required until a solution comes to bear. So from that perspective, I'm not overly concerned that the government won't act in real time and won't be responsive to an evolution of cases if it moves beyond Victoria. But our assumptions, our baseline assumptions have always been that, well, even when we did the very first webinar, we had the peak cases occurring in early June, or in May, and then the belief that restrictions would start to ease through June. That happened a little bit quicker across the aggregate. We did have it then tapering off rather than having a large second wave. And that is still our view. 80% of the economy is not experiencing a second wave. So from that perspective, we haven't really shifted our base case. We are, of course, concerned that what we've seen elsewhere around the world, it could continue to escalate. Yet that's not what's been brought out by the data. If you look again at the US, new case growth is actually peaked out 3 weeks ago. So we're confident that although the number of new cases will continue to go up towards 80,000, inside 3 weeks it'll largely peak out globally as well, in the US as well. So thus far, I think our base case still holds.
Great. Thanks, Tim. Just a follow-up question for you. Why are you so confident that tax rates will genuinely impact savings rates / consumption, given that many Australians have never experienced a more bleak outlook in their working lives?
Yeah, so it's an interesting one, this one. I mean, it's two-faceted. One is the savings rate is if we cast our mind back, what happened in the financial crisis? The savings rate rose very large, very quickly, and stayed high for a period. But it got reinterpreted through the passage of time as to what actually drove it. Most people look back now and assume that savings rates spiked because people were scared and because people saved the fiscal handouts at the time. The micro data told us that wasn't actually the case. What actually happened was that the people spent the fiscal handouts pretty quickly, but the saving rate went very high because people got ahead of their mortgages. The RBA cut rate a lot. So the nature of this system is that you tend to prepay when rates go down. And secondly, because it was a slower fall for equity markets, but it was a persistent fall. So people actually sold their risk assets and the money went in the bank. What happened this time? Well, the RBA couldn't cut as much, so the savings rate from that perspective couldn't go up as much. And it was such a rapid fall in risk assets that very few people, if you were lucky enough to sell in the time frame that happened, then good luck to you. But for most people, they couldn't actually liquefy their risk assets in time. So those two aspects are important. The third aspect around savings rates is it tends to be inversely related to wealth. And I think the base assumption across not just the economics community, but for just about everyone, is that this very large economic shutdown would cause real disruption in terms of house prices and financial wealth. Well, as Dion already indicated, house prices haven't fallen very much at all yet. And financial prices, as Dion has also indicated, have actually gone up. So, not to their highs, but in the US, they've actually completely eroded the losses. So the wealth impacts have been far smaller. So those aspects means the savings rate can't go up as much, or shouldn't go up anywhere near as much as we saw in the financial crisis. The next aspect is that tax cuts is a permanent effect. Now, when you get a short-term government handout that is one-off in nature, it doesn't shift your permanent savings behaviour. When you get a permanent lift in your income via a tax cut, you're more likely to consume out of that. And that's really what we're getting at here. Permanent cuts in taxes give the permanent boost in income, which you are more likely to consume out of.
Thanks, Tim. One for you, Dion, and there's a bit in this one. Thinking about discretionary retail, it seems C19 is enabling larger retailers to reset their bricks and mortar footprints. While larger bricks and mortar retailers come out of C19 in a stronger position, aren't consumers going to be desperate to head to T1 shopping malls when this is all over? And isn't that potentially a negative for pure play online retailers that may benefit from a C19 jump?
Sure. Thanks, Peter. There's a lot in that question. It is hard to generalise between large and small and bricks and mortar and online, because there'll always be winners and losers. But if you had to generalise, you'd say online is a winner. And if you look at the physical retailers that we invest in or we talk to, they've realised that there is, frankly, that the progress they hope to make online over 5 to 10 years appears to have happened in the space of 5 months. It's a viable, profitable channel for them, and it's growing quickly. Consumer acceptance has skyrocketed. So I really don't see that reversing. The debate between tier 1 and tier 2 malls depends entirely on, frankly, on whether or not there's a vaccine or effective treatment. Because what we're finding is a lot of people at the moment don't want to head into malls in the city. They don't want to be in crowded malls. They want to be in local neighbourhood strips and the local neighbourhood shopping centres. That could well reverse in the event that there's a lot of medical progress that makes its way forward. What I'd say, though, is there's a few things we can expect. Is large retailers will probably want less space than what they currently have. A lot of small retailers will disappear. And I suspect rents will be lower and vacancies will be higher. And that's very much the mindset that guides our thinking around where we want to invest at the moment.
Right, thank you. And we're running short of time, but perhaps one more that's just come through. And Tim, you may be best to answer this question. Today's job data release confirmed 210,000 new jobs, which was twice consensus. Has a significant recovery started?
Well, yeah, I think it's very consistent with the V-shaped type recovery. You can see it in terms of things like business confidence having recovered. You can see it in terms of the retail sales data that Dion was referring to. And this is really reflecting people bringing back people that were furloughed back into the workforce. So the answer is yes. I think it's also important to put it in context. It's the largest employment monthly increase in history. A lot of it obviously was in part-time employees, which speaks to the arts, food, recreation, those sorts of sectors being called back into work. But also to put it into international comparative purposes, which is something that the media won't pick up on, and indeed I think they should. The unemployment rate, when you add back the furloughed employees, peaked in April. It's already 4% lower than its peak as people re-engage, people are being called back in. There is a way of so when we look at the unemployment rate, it's done differently in the US and Canada to us. They basically include those furloughed employees. We don't. When you put it on the same basis, we've actually had a much bigger fall in the unemployment rate than the US, and much, much bigger than Canada. And it speaks to this fiscal stimulus. It speaks also to the better health outcomes that we've had. So the answer is certainly yes. And I think that process and lowering the real unemployment rate, as I'll call it, will continue for the balance of this year.
Thank you, Tim. That brings today's webinar to a close. On behalf of Yarra Capital Management, a massive thank you for joining us this afternoon. We really do appreciate you taking time out of your valuable day to spend with us. If there are any questions following today's session, please contact myself, Nick Green, or Ramal Hakopium in the first instance, and more than happy to help out. Following today, you'll receive a short survey. Any feedback greatly appreciated and more than welcome. I'll ask you to keep an eye out for an invitation that should be out very shortly with regards to next week's session. And on behalf of us all, many thanks and have a great day.
Thank you.